Hey everyone, welcome back to Corporate Decoder. Today, Envoy Medical just filed a Form 8K, and I am seeing a potential warning sign for its stock listing. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is struggling to stay listed on the Nasdaq, and they've been granted more time to fix it. But the path forward looks tricky, so what we have here is what is called a Form 8K filing. Think of it like a company's way of telling the public about really important events that are happening right now, things that investors need to know about immediately. This particular filing is about the company's status on the Nasdaq stock market. The key date here is reported as May 19, 2026. This is when something significant happened that triggered this filing. The company we're looking at is Envoy Medical Incorporated. They're involved in medical devices, specifically cochlear implants, which help people with hearing loss. Now, let's get to the core issue, Envoy Medical's stock. Their class of common stock has been facing a problem with the Nasdaq exchange. The Nasdaq has rules that companies must follow to keep their stock listed and traded there. One of these rules is about the minimum price a stock must trade at. This filing discusses the company's class, a common stock. They also have something called Redeemable Warrants. These are like options that give someone the right to buy the company's stock at a set price in the future, which in this case is $11.5 per S-hair. This is the stock market where Envoy Medical shares are traded. Specifically, it is the Nasdaq capital market, which is typically for smaller companies. This section, item 3.01, is the heart of why this filing was made. It is all about whether the company is in danger of being kicked off the Nasdaq exchange. Back on the 19th of November of last year, the company got a notice from the Nasdaq staff saying they were not meeting a specific requirement. The problem is with their common stock, it had fallen below $1 per S-hair and stayed there for 30 business days in a row. This is a big deal because the Nasdaq requires stocks to maintain a minimum bid price, usually $1 to stay listed on the capital market. This is often called the bid price requirement. When a company gets this notice, they usually get a grace period to fix the problem. In Envoy Medical's case, they were given 180 days, which is about 6 months, to get their stock price back up above $1 for at least 10 consecutive business days before May 18, 2026. This date, May 18, 2026, was their initial deadline, or the compliance date. And here is the update as of May 19, 2026. Envoy Medical had not met that $1 minimum bid price requirement by their first deadline. However, Nasdaq has given them another chance. They are now eligible for an additional 180 days, pushing their new deadline to the 16th of November 2026. This is their second compliance period. Why did Nasdaq give them more time? Well, Envoy Medical still meets other important listing rules, like having enough publicly traded shares with a certain market value, and they've told Nasdaq their plan to fix this. Their plan, if necessary, is to do a reverse stock split. Now, what is a reverse stock split? Imagine you have 10 shares of stock, each worth 50 cents. That is $5 total. A 1 for 10 reverse stock split means your 10 shares would become 1 share, but that single share would now be worth $5. The idea is to artificially boost the stock price per S-hair. This is a classic move for companies that are struggling to meet minimum listing requirements. Historically, about half of companies that do reverse stock splits, especially smaller ones, eventually end up delisted anyway. For example, in 2021, Kodak did a 1 for 20 reverse split, and unfortunately their stock continued to struggle, seeing about a 40% drop in value over the next 3 months following the split. A hypothetical $1,000 investment could have fallen to around $600. It is a sign that the underlying business might not be performing well enough to support a higher stock price organically. The company is saying they will do this reverse stock split if needed to meet the $1 bid price. This tells us they are concerned they might not be able to organically get their stock price up before the new deadline in November. This section, labeled Forward-Looking Statements, is basically a legal disclaimer. It tells us that the company is making statements about what they expect to happen in the future, but these are just projections, not guarantees. They're saying that things like their ability to fix the listing issues, whether a reverse stock split will work, and the overall market price of their stock are all uncertain and subject to many risks. They mention risks related to the unpredictable nature of market prices, the costs and distractions involved in addressing these listing issues, and other uncertainties detailed in their other filings with the Securities and Exchange Commission. They are essentially warning investors not to put too much faith in these future predictions. Now, looking at Envoy Medical's situation, they are clearly in a tough spot. While it is good they've been given more time and are exploring solutions like a reverse stock split, the fact that they've had to resort to this strategy often signals underlying business challenges. They've been trying to regain compliance since November of last year. And now they have until November of this year. The company's stock has been trading below $1 for a long time, indicating that investors are not valuing the company at a price that meets Nasdaq standards. This can also make it harder for the company to raise money because a low stock price can deter potential investors. While the recent news about their pivotal trial and financing is positive for their core business operations related to cochlear implants, the Nasdaq delisting threat is a significant overhang. If they do get delisted from the Nasdaq, it would mean their stock would trade on a less regulated the counter market, which typically means lower trading volume and less investor interest. The risk for investors is that the reverse stock split might only be a temporary fix, and if the underlying business doesn't improve to support a higher stock price naturally, they could face delisting again or even bankruptcy. What I'll be watching closely is whether their clinical trial success and secured financing translate into stronger financial performance and a sustained increase in their stock price, or if the reverse stock split is just a way to delay the inevitable. The fact that they haven't been able to regain compliance for such a long period is a major concern. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. You can also join our Discord community linked below.